Today we will discuss FRM level 1. It has four main domains. The first domain is foundation of risk management. Risk is becoming very important nowadays after 2007 and 8 crisis in United States in mortgage, starting from mortgage industry. Risk management is becoming more and more important. So all FMCGs, NMCs and banks, financial institutions and IFIs, they are focusing on risk management. That's why those who are interested to involve their career in the financial risk or risk management, FRM qualification is the right choice for them. We will start our agenda. Agenda for today is very comprehensive, and we will start our discussion with the risk management, and I will take an helicopter view. This view will tell us that what is the meaning of risk, how to manage risk, how to choose risk, how to select risk, how to give the risk responses, what will be the risk management, and other ancillary knowledge related to it I will discuss in detail. Moving forward, we will move to a corporate risk management. When you are specifically talking about a large corporations which are subject to a lot of risk like systematic, unsystematic, they are dealing with different currencies, so they have liquidity risk, default risk, currency exchange risk. They need certain things to understand in order to control. Moving forward, we will try to see what is a corporate framework. So corporate governance and risk management, this is really important because governance is a combination of policies and procedures by deploying physical and non-physical equipment. So we will see what is the corporate governance requirement, how Sarbanes-Oxley links with it, what is the concept of audit committee, how we divide the management with the ownership, between ownerships we keep them separate, and how we create extra layer of corporate governance. This is we will see on financial institution and other companies in large. What is ERM? ERM is very interesting. This is enterprise risk management concepts. We previously were trying to cover the risk of each department, but the concept has become larger, so we have to cover the organization with full approach. So we cover from top to bottom, we cover all the departments, we cover the lower management, upper management and middle management in between. So how this ERM work, what are the strategic objective, how operational objective works, what are the component of this, what is the concept of control environment, information monitoring, event identification, and other factors that I'm going to explain today. Then we'll see risk taking and risk management by the banks. Banks are subject to various risks. Bank is a platform who takes money from investors and they give it to the people who are looking for. And the difference between what they are giving to investors and what they are taking from the interested parties who has borrowed from them, the difference is their profit, is their income. They subject to certain expenses, so they maintain their profitabilities. So they buy euros, they buy pounds, they have different kind of currencies they deal in. These currencies are subject to fluctuations, so that create a risk, which create a need for hedging products. So how to do hedging, what is the concept, this is we will discuss in this course. They have default risk. People will take the money from the banks and they will not return. This is a default risk. Then the country they are operating in, what is the money policy, what is the central bank policies, these all will decide that how to handle the risk management by the banks. As a student of risk management, we should be aware about the past scenarios, events and circumstances that arises and they create a big financial crisis in the world. So we will discuss a lot of popular and well-studied case studies. It will enlighten our mind in terms of what people did, what was their mistakes, what happened, and what could be the possible solution for correction in future. Moving forward, we will discuss in detail the credit risk of 2007 when the money and liquidity goes very down. You might have a very big number of funds in your bank, but actually the cash was shrinked. So that created a liquidity risk. This risk, how it created, what was the effects, what were the outcomes, what were the policies which bring these kind of issues. This all we will discuss while discussing credit crisis of 2007. In terms of risk management failures, what are they and when do they happen? We will rightly focus delineating efficient portfolios. So what we do is now, suppose previously, maybe 50 years before, if you have $1 billion, so you want to spend in your own business and you want to grow. But slowly we get this concept that don't put your eggs in one basket. So what we did is we try to split the money that we have, even starting from $1 million. You have to divide your business into different nature of businesses. So every business will have its own risk and return. So if your one business is down, so you still can survive from the other businesses. This is the concept of portfolio management. This is a great discussion that we are going to do in the later part of our lecture. But so far we will try to see what are the things that if we ignore, it can cause us a failure in terms of risk management. Moving forward, we'll try to see the mathematical part to handle the risk, and the very famous model that we have is CAPM, CAPM, Capital Asset Pricing Models. Capital is an accounting term that says that long term or any asset that useful life is more than 1 year, which is subject to depreciation or amortization, how to give them pricing. So we bring the concept of risk free, we could bring the concept of beta, we understand how to get the market premium. This is a very useful and effective model, and we will discuss in detail. Then we'll see that how it applies to a single security, and for multiple securities, of course, we have another model that is called arbitrage pricing theory, APT shortly we called. CAPM is squeezed to only one security, but if you are an investor who has multiple securities with you, so you would not be able to handle the calculation through CAPM. You have to move towards APT theory. Only difference between them is in APT theory you have multiple stocks, securities, and it can be handled through this method. Moving forward, we will discuss information risk and data quality management. Data is the key for us as a financial risk managers. If I have a wrong data which is unauthentic and has no relevance, or it's not authentic, accurate, reliable, trustful, timely, then we will be in trouble. So how we get the data, what are the primary sources, what are the secondary sources, how we test the reliability, this is a very important discussion that we are going to do for this. Moving forward, we'll see principle for effective data aggregation and risk reporting. So first of all, by using statistical techniques, we gather the data, financial data about movement of stocks and movement of interest rates and other related financial KPIs, indicators. And in the last, of course, we'll discuss the GARP, Code of Conduct. Code of Conduct is very important for the members of GARP. that is a global association for risk professionals, and they offer this exam FRM. So we should be rational, we should be objective, we should not be emotional, we should not adopt subjectivity, we should adopt objectivity. Then of course we should try to increase, we should understand the client rights, we should understand the employer rights, we should understand what different stakeholders are involved. This is in an ethical way. We will understand how to manage the risk. So this all is the scope of our discussion. We will start our detailed discussion now with the first topic, risk taking, a corporate governance perspective.